So let's say you've got $500,000 to put to work. Whatever the source, the question is the same. What do you actually do with it? And the answer is rarely what most investment content tells you. At this level, the investment itself is the last thing you should be thinking about, not the first. Because there's a move a lot of people make with money like this that feels tax smart and quietly does the opposite. It can trigger the exact tax that they were trying to avoid. I'll show you what it is in a few minutes. It's not what most people expect. I'm Kris Dureau with Green Private Wealth. We help Canadian families turn financial complexity into a clear plan, so you always know where you stand and how your future is protected. What decides how much of this $500,000 you actually keep isn't the fund you pick, it's the structure around it. So let's take it in the order the decisions really happen, the same order we take with a client. Before a dollar gets invested, 3 questions have to be answered, and none of them are investment questions. First, what is the money for, and when do you need it? A 48-year-old business owner investing $500,000 they won't touch for 15 years has a completely different framework than a 61-year-old who needs to generate $50,000 a year from it starting 2 years from now. Same amount, completely different strategy. Second, where does this money fit with everything else you've got? At this level, you're probably juggling an RRSP, a TFSA, a non-registered account, and maybe even a holding company. The $500,000 doesn't get invested in isolation. It goes wherever it creates the most tax-efficient outcome for the overall plan. That's very different from just asking which fund to buy. Third, and this is one people skip, is there a tax bill attached to it? If this came from selling a business, a property, or investments, you may owe some capital gains on that in April. Investing money you're about to owe the government is a serious risk. The after-tax number is the only one that counts. Start there. Once you know the money's ready to invest, there's one more timing question. Do you put the whole $500,000 in at once, or do you feed it in over time? The data is actually clear on this. Investing it all at once usually wins because markets rise more often than they fall. So the sooner it's in, the more time it spends growing. Waiting on the sidelines for that right moment tends to cost you more than it saves. But it comes down to more than just the math. It comes down to what you can actually live with. If putting the full amount and watching it drop 15% the next month would rattle you into selling, then spraying it over those 6 to 12 months is a smarter play here. Not because it earned more, but because it keeps you invested through the rough patches, and that's very important. The best strategy on paper is worthless if you can't stick with it. This is also where those 2 people from earlier, their decisions are different. The 48-year-old with the 15-year runway and no near-term need can put it all to work at once and ride out those bumps. The 61-year-old drawing income in 2 years has less room to recover from a bad stretch, so a steadier phased approach may fit them better. Now the structure. This is where the real money is made or lost, and it starts with which account holds what. TFSA first, almost always. As of 2026, the room adds up to $109,000 per person. For a couple, that's $218,000 growing completely tax-free and never taxed on the way out, extremely important. And here's a detail that's easy to overlook. Money in a TFSA is visible on your tax return. Never shows up as income. So in retirement, you can draw from it without raising your taxable income at all, which keeps you in a lower bracket and protects the government benefits that shrink as your income climbs, such as the OAS clawback. Now, the room is capped, so most of the $500,000 sum is not going to fit inside it. You'll fill whatever TFSA space you have, and the rest has to live somewhere else, which is exactly why the non-registered decisions coming up matter so much. RSPs are more of a judgment call. The deduction is valuable if you're in a 50% plus tax bracket now and expect to be in a lower one in retirement. But if you already have a large RSP, your forced withdrawals at 71 might already be set to push you in that top bracket. Piling more in today can just move that tax bill from now to later, sometimes a bigger one, worth modeling out before you contribute. And if you have a holding company, the whole conversation changes. Passive investment income inside a corporation gets taxed around 50%, which sounds brutal, but capital gains inside a corporation are the most efficient income there is. The non-taxable half flows into something called the capital dividend account, CDA account, and it can come out to you completely tax-free. So for incorporated clients, what earns income inside the company versus in your own name becomes one of the most important decisions you're going to make. Once you know which accounts you're using, the next question is, what goes where? Most investors never think about this at all. And it's where a lot of tax quietly leaks out. The rule is simple: match the investments to the account. Fully taxed interest from bonds, GICs, or savings, they belong in a registered account where it's sheltered if you can. Your highest growth assets belong in the TFSA because it shelters not just the income, but all the growth. This leaves your non-registered account. And this is where the obvious tax-efficient choice is the one that quietly backfires. Let me show you. Here's the move. Say you want your non-registered money to be tax efficient, so you load it up with Canadian dividend-paying stocks. Dividends come with a tax credit, so this feels smart, and for a lot of people it can be. This matters most as you approach retirement, but you're choosing what fills this account now, so it's worth understanding early, whatever your age. Here's the quirk. When a Canadian company pays you a dividend, it's already paid tax on that money. To avoid taxing it twice, the government inflates the dividend before it hits your return by 38%. They call it the gross up. So you earn $1,000 in dividends and $1,380 shows up as income. You do get that dividend tax credit, but it lands further down against your tax bill. It does nothing to lower that income number. And that income number is exactly what OAS Old Age Security looks at. Once you're over that threshold, every extra dollar claws back your old age security by 15 cents. So compare what each kind of income does to that number. Earn a dollar of interest, full dollar lands on it. Earn a dollar of capital gains, and only about 50 cents lands on it, because only half of that gain is counted. But earn a dollar of eligible dividends, and $1.38 lands on it because of that gross up. So the income that felt the most tax smart, the dividends, is the one pushing you towards the clawback the fastest. And this is exactly what makes the TFSA so powerful. Nothing inside it ever lands on this income line. It's the one account that stays completely invisible to the clawback. That's what makes it the most valuable place to hold money at this level. The right structure isn't a formula, it's a fit. So at $500,000, yes, the investment matters, but it's not the decision that matters the most. The one that matters the most happened before you invest a dollar. What's this money for, and when do you need it? Which account holds it? And what kind of income throws it off? Because how that income lands on your tax return can quietly decide how much of it you keep. Get those right, and you hold on to far more of that $500,000 than you'll ever would have chasing a slightly better fund. If this was helpful, we put together a free guide called the Canadian Resource on Investment Basics. It walks through account structure and how to invest with clarity at any level. The link is in the description. Give the video a like if it helped, send it to someone facing the same decision, and subscribe for more planning content built for Canadians. I'm Kris Dureau with Green Private Wealth. Thanks for watching, and I'll see you in the next one.